Hi, and welcome to the You Sustain YouTube channel. So, today we are going to talk about getting financing for your company through climate risk assessments and ESG incentives. So, let's talk about what that actually means and how that could benefit your company. Now, most companies have to accommodate to some sort of law. Either it can be regional, national, continental law, and so on and so forth. But in many instances, what you report to the state, for example, as according to law, is the same that goes to financial institutions such as banks. And one side is this compliance with the law. And on the other side, you can actually, as a company, gain something from this, either through financing, green loans, or green bonds. So, what does the bank have to do with this? Now, if it's one thing a bank looks at when they are giving funding, loaning you money, and what so and so forth, is risk. Banks love risk. Well, actually, that's what they don't love. They love to see risk assessments showing that you are not at risk. So, because the bank is loaning you money as a risk, and what they want to know is, are you able to give that money back to them? Because there's always a risk for a bank to loan you or give you money that you will actually not give it back. So the bank is looking at your risk to see if you are capable of giving back the money that you are loaned. Now, for you, this means that if you are able to provide this information to the bank in terms of climate risk assessments that you have done internally, you are showing the bank that you yourself have accorded for this risk, so accounted for this risk. Or these risks, there can be several. So it's showing that you not necessarily don't have any risks at all, it's just showing that you are knowledgeable of these risks, you have identified them, you can see how much money this will potentially cost you, or any mitigation strategies that you have implemented in order to lower these risks. Okay. So the bank also needs to report to other entities. For example, in Europe, this will be the European Central Bank, which is the banking supervision of the EU. So the bank is reporting to the EU in terms of their risk, and you are reporting your risk to the bank. So it's sort of like a chain of reporting here, where everyone wants to keep the risk as low as possible and everyone gets the money that they want. So this is just to show you what it looks like for the bank. So the bank also has guidance on climate related and environmental risks. So this is what the bank is looking at when they are assessing you as a company. So what does this mean for you? This means that you as a company, you do a risk assessment using the TCFD framework, for example, so Task Force on Climate Related Financial Disclosures, which is a framework public that everyone can use in order to report on their climate risk. So what you do is that you do this assessment of your company and your value chain. And you can see what risks are high risk, medium risk, and low risk. And as an overall, you can give your company a climate risk score, or the bank will give you a climate risk score. This means that if your company can provide and say that we are a low risk for you as a bank, they can allocate you money. The bank does not want to allocate money to a company who is not viable to give this money back. So, if you can provide this information already to the bank, showing that you have already shown that you are capable of doing this assessment, that gives them more reassurance that they will get their money back. So, this is one way to get funding from financial institutions. So that would be to provide your risks, say that you've done an assessment, you have identified your risks, and you have stated how much money is actually at risk. And then there's also another way of getting funding for your company, and that would be through these green loans. So there are some green loan principles, for example, the use of proceeds, process for project evaluation and selection, management of proceeds, and reporting. So these are general standard principles that the bank will use in evaluating you. So, how do you as a company show that you are fitted for these principles? Well, first and foremost, we need to report our greenhouse gas emissions because the bank needs to see that the project that they are funding, or you as a company, you are actually working towards something sustainability related or environmentally related. So, in order to do that, we need to show quantifiable data. That means that they need to be able to see the data and what your plan is with the data. So we report our emissions and then we can start tracking our progress. So, for example, we can set a target. It could either be a science-based target approved by an organization, or it can be an internal target set for the company. Of course, there's always an advantage to have your target approved by a third-party organization, but for this short talk here, we'll just keep it as a simple target. So if you can show the bank that we have put in several incentives, we have a target, and we have a goal in reaching our target, and you can provide this to the bank, that means that you can get a green loan. Now, the bank has a have a sum of money that they can distribute as green loans. And that would be, you can get, for example, more money than you would get with a normal loan, and you can get lower interest rates. So this is really good for your company in order to have investments for a project. It could be bonds, it could be loans, and so on and so forth. So this gives you as well more incentive to do your reporting because you will actually gain something back. So these are two different ways of being able to get these loans. Now, why is this relevant for the bank? So one is the climate risk, which is also essential for the bank. Of course, they want their money back. But why do they have incentives for this, for the green loans? Well, because banks also have things they need to align with. So there's a taxonomy also for the bank, and they also have emission reduction targets, for example, which means that they need to show that their portfolio is green. And that means that the bank is needing to collect GHG or carbon accounting data from all of their portfolio companies. So if you are able to show that you are the company that is providing data, and you can also provide targets saying that you will reduce your emissions. So that would be really good for the bank, because then that would naturally also incline the bank's emissions. So it's really much a give and take here. So the bank is gaining that they will get lower emissions, and you are gaining because you are getting funding at a lower interest rate. So it's a win-win for everyone. So, to tie it all back together, your company can have a lot of financial incentive from the bank just by providing your GHG accounting, saying that you have measured your emission to start with, you have a plan to reduce them, you have a strategy to align with all the targets, you have collected and found information and identified risks in your value chain, actually stating how much money this could potentially cost you and the bank, and the mitigation strategies you have to reduce them. And the bank can report to their governing body or the central bank or whichever organization that would be. Everyone is happy, and you are gaining financial incentives from the bank at either a climate risk level or as a GHG incentive. If this is something that you see as valuable, please come and check out our online course platform, where you can learn a lot more on both how to do your carbon accounting and also how to do a climate risk analysis. So if that's interesting to you, then have a look or get in touch with us. Bye-bye.